Hi everyone, welcome to the session on estate planning. This is a part of the NISM 10th syllabus that we are covering, and this forms a part of the NISM 10th course which you all have joined. For those of you who are watching on YouTube, the NISM 10th, 10th, and 15th courses are live on my website. You can go to the website link in the description and check them there. There's currently a discount which will not be there after this week. So if you're keen on starting a career in finance or generally want to learn about personal finance and investing, please feel free to join the course. As usual, the standard disclaimer applies. This is not financial advice. Any action and their outcomes based on our discussions are solely your responsibility, and I shall bear no responsibility of the liability arising out of such action. All facts and opinions are my own, and they are not associated with any organization that I am associated with or have been associated with in the past. So, the objective of personal finance is to make sure that your personal financial matters are secure during your life and after. Estate planning mainly deals with the planning after one's life is over. So we earn money, we invest money, we create assets, and a part of it we want to leave for our heirs as well. Estate planning is the process which answers the question of what happens when a person dies or he becomes incapacitated, what becomes of their assets, their liabilities, and their estate in general. Estate, the word, is used for a catch-all term for all kinds of assets, liabilities, net worth, etc., that a person leaves behind after his death. It is a structured process which will determine how the property, the rights to use those properties, and the financial responsibilities associated with those properties will be handled. Now, there is a some kind of a myth that estate planning is only useful for very rich or high net worth or ultra billionaire kind of a people, right? However, that is not true. Anybody who has any kind of assets that they want to pass on to their heirs need to figure out estate planning, and it's a very simple process for people who want to create a simple, straightforward estate planning process. So, why is estate planning important? So, there's a couple of reasons why somebody would want to do some kind of estate planning. First is it allows the individual to decide how their property will be distributed. Whatever is the property, whether it be movable or immovable, you get to take a call on how it will be distributed after your life or after you become incapacitated. It can be distributed to your heirs, to your family, to maybe something for your wife, for your children, for yourself, and for people you want to leave behind some portion, maybe for your friends, etc. as well. Who should inherit in what proportion? So, how much should be given to each of your, inheritors? Who will manage the estate if they become physically or mentally unable? So let's say your inheritor becomes for some reason they're incapacitated. Who will manage the estate in that case? How will the outstanding liabilities be settled? If there's some loans, etc., that are outstanding even after your death, how will that be settled? Will you liquidate some assets? Will there be some cash flows coming from some assets which will go to paying those loans? How will that be settled? And whether surviving family members, especially your spouse, will have adequate financial security. So, let's say somebody's spouse is not earning or does not have an independent source of income, you can leave behind certain sources of cash flow for them as well. And finally, how to provide for charitable intentions. Let's say you want to leave behind something to a temple or a trust or some other kind of charitable institute, you can do that via this estate planning process. It will minimize disputes and it will ensure that there is a smooth distribution of assets. Now, who needs estate planning? I mentioned earlier that it is not something for ultra high net worth individuals. It is useful for everyone who is at a stage where they are retired or they are planning to leave behind something for their inheritors. So, any family with a minor children that needs a guardian should think about estate planning. Any individual who has significant liabilities that are likely to outlast him should think about estate planning. Then persons who own property across different states should think about estate planning because different kind of rules might apply to properties in different states. Small business owners who want to continue their business or want to liquidate their business or pass on their business to one or two heirs should think about estate planning. Then individuals who want to manage their estate taxes. So there can be certain tax implications when passing on inheritance to your inheritors as well, and they should think about how to plan the taxation liabilities. And those concerned about disability or long-term care. So if you're planning to live, let's say after your retirement, you need some kind of help in your retirement years, you lived up to let's say 90 years of age, and you want to create a proper plan before you become too old or incapable of doing that kind of planning, then you can start creating an estate plan for yourself. So the idea is that you should be prepared against any kind of uncertainties of life. Now, a well-crafted estate plan has a certain kind of goals, right? It needs to make sure that it fulfills certain criteria. First is preservation and smooth transmission of assets. A lot of times, assets are either not able to transfer fully to the inheritors, or there is some kind of legal dispute, etc. And therefore, they need to be preserved and transmitted smoothly to the inheritors as envisioned by the person who's creating the estate or the will. Second, there should be guardianship protection for the minors. It should not be the case that just because the elders or the owners of the property have passed away, it should not be the case that the minors should be deprived of their guardianship coming from that property. Then, management of finances and healthcare when the individual is incapacitated. Is it your property if it's not helping you in your incapacitation years? So, you need to figure out how to craft a plan in order to manage your finances and your healthcare when you are incapacitated. Then it should provide adequate provision for liabilities after death. If there is certain kind of liabilities that will continue after your death, then you have to provide adequate provisions for that as well. Then transfer of specific assets to intended beneficiaries. If there are certain particular assets which are more beneficial to certain particular beneficiaries, let's say you want to leave a particular house to your daughter or a particular property to your son, then all of these things can be taken care of by the proper estate planning process. Protection and lifetime care for special needs dependents. If there is someone who needs some kind of special care or special attention, then you can allocate something to take care of them as well. Financial security for minors until adulthood. So this goes well with the guardianship point that until a child comes into his own and becomes a legal adult, he should be provided for in terms of financial security. And then there is efficient asset collection, consolidation, and distribution. If there are a lot of scattered assets, then a good planning process, estate planning process, allows you to consolidate and redistribute them properly. Now, another term that often goes along with estate planning is called succession planning. Succession planning is often heard in cases of business management's planning for succession of the CEOs, etc. Estate planning is responsible for covering personal assets and the distribution of death of these distribution after death of these assets. But succession planning has to address the continuity of a business. So it should not be the case that for some unfortunate reason, let's say if the chairman or the CEO passes away, there should be no disruption to the business, and there should be a plan on who will step into the shoe, maybe in a temporary role or in a permanent role. So during the lifetime of the owner or the executive or the chairman, they have to identify the successors. They have to evaluate their capability, and they have to decide whether they want to sell or transfer the business in case they are not in a position to run it again. Even if the business succession plan exists, then there has to be an estate planning for the personal assets of the person. So the CEO or the chairman or the owner of the business himself, he has to create a separate plan for his or her personal assets. Now, we've been talking about estate planning. It's important to decide what constitutes an estate. Now, for the simplest definition is that it includes everything that you either own or control, either individually or jointly, right? So, if even if it's straightforward that any kind of mutual fund, stocks, bonds, property, real estate, etc., that you have, that is a part of your estate. But even things that you control via, let's say, a trust or any kind of joint mechanism with another person or any kind of other entity like, let's say, company, etc., that is also considered as a part of your estate. It can also include assets that will arise upon your death. So let's say there's an insurance claim that is payable at your death, then that becomes a part of your estate as well. So there is generally three categories of any kind of estate assets. First is gross estate, which includes all financial assets, any kind of property, any kind of investment, any kind of business interest, NPS, insurance, basically all the financial and non-financial assets that you can think of. Then there is residual estate. Residual estate includes personal belongings, jewelry, furniture, unallocated investment, and any outstanding dues. So keep in mind that it also includes the liabilities also. And then there is estate debt. So any kind of liabilities, loans, taxes, legal dues, fees, outstanding business balances that are payable, all of these are a part of estate debt. And together, these three form the three categories of the constituents of an estate. What happens if somebody dies without creating an estate succession plan or a will, right? So a person is considered an intestate. So the term for somebody who dies without a will is intestate. And if they don't have a valid will or if don't have a will at all, they are considered that they are intestate, they have passed away intestate, and therefore the distribution have to follow the law of the land. Now, the law depends on what religion the person himself was from. If he was a Hindu, Sikh, Jain, or Buddhist, then the law that is followed is called Hindu Succession Act, and we will see in detail what Hindu Succession Act is all about. If he was a Christian, Parsi, or a Jew, then the Indian Succession Act applies, right? Muslims are governed by the religious personal law, and all of the legal heirs must apply for a succession certificate to claim these movable assets. If somebody is dying without a will, that means dying intestate, then there can be delays, there can be disputes, there can be legal matters that can arise because of unintended distribution of these assets. So, how to make an estate plan, right? There are certain documentations that need to be done. All of these might not be required, but at least one or two are essential if you want to create an estate plan. The first document is called a will. I think we know about wills from general conversation in the real life also. A will is nothing but a distribution of assets, right? It appoints guardian. It can create testamentary trust. So it's a document which figures out and specifies the distribution of assets, what these assets are, who these assets will go to, if there is any trust or trust like structure needs to be created to distribute these assets or manage these assets. Trusts is a legal arrangement which holds the asset for the beneficiary or on behalf of the beneficiary. It can be living trust or a testamentary trust, right? So, which means that somebody can create a documented trust saying that until my ward or my children come of age, they become of legal age, the trust shall hold the property on their behalf. Then there is something called a power of attorney. A power of attorney is a legal document that authorizes someone to manage finances if the person becomes incapacitated. So, if somebody becomes incapacitated, they can give a power of attorney to a known person who will manage the financial matters on their behalf. They can put signatures on their behalf, open bank accounts, close bank accounts, etc. Then there is something called a living will. A living will is something that is an end of life healthcare instruction, which means that if somebody is nearing the end of life, they are becoming incapacitated, they can provide instructions on how they want to be managed in their palliative care. Then there is a concept of nominations. Any kind of financial instrument that you invest in, they normally require you to make nominations on who will be the nominees in case of the death of the owner of such assets. So, in case there is some beneficial nominee, let's say in the case of life insurance, then they supersede the nomination. Otherwise, the nominee, whoever you made the nominee, will become the inheritor of the financial asset. Now, what are the laws that govern the creation of estate planning in India? So, the main law is called Indian Succession Act of 1925. This act has two things that mainly govern. The first is called testamentary succession, which means that when a valid will exists, this act governs this valid will. And when the absence of a will is there, when there is no will and there is an intestate succession that happens, then that is also governed by this law. This law is decided based on the religion. So the person who creates the will, their religion decides what is the applicable rule here. If there's a person is a Hindu or a Sikh or a Jain or a Buddhist, then the Indian Succession Act applies for wills. However, if they die without a will, they die intestate, then they are subjected to Hindu Succession Act. And we look at the details of Hindu Succession Act in a moment, but this is what the rule is for Hindus, Sikhs, Jains, and Buddhists. For Christians, the ISA is applied for both. For Parsis, ISA is applied for both. And for Muslims, they are governed by their personal religious laws. And we'll look at the details of some of these in the next slides. First up is Hindu Succession Act. For Hindu males and for Hindu females, there are certain provisions in the Hindu Succession Act. So if somebody dies intestate, then the Hindu Succession Act is what governs the inheritance rights. For Hindu males, the class 1 heirs are getting the highest priority. What are the class 1 heirs? These include the son, the daughter, the widow of the person, and the mother, right? So this is the order of the succession class 1 heirs. If there is no class 1 heir, then the class 2 heirs will inherit. Who are they? They will be like the daughter of the son or the son of the son, or basically next of kin after the class 1 heirs are not existing. If none of these exist, class 1 or class 2 both don't exist, then the property goes to the agnates. What are agnates? Agnates are relations which are through male relatives. If there's no agnates, then it goes to cognates. Cognates are relatives where there's a female relative in between. So this is the rule that is applied for Hindu males. For Hindu females, the property is the woman's absolute property. So it is for her to decide what exactly is supposed to be done. The order of heirs is like this. First is children and husband at equal priority. Then the husband heirs, which is son, daughter, widow, mother, etc. Then there is parents, then father's heirs, and then mother's heirs. So this is a summary of what the Hindu Succession Act looks like. In Muslim personal law, there are certain succession rules. Now, these are coming from Muslim religious documents. There are two categories of heirs. There are sharers and there are residuaries. Sharers include fixed shareholders. So, there's fixed shares that are determined by religious rules, which include the spouse, the children, and the parents. And there is a residuaries who are allowed to inherit the remaining estate. What are the key features? First, there is no concept of co-personality or birthright. So, unlike Hindu succession law, where ancestral property is distributed equally between inheritors, here there is no concept of birthright, right? So, this determination is done entirely based on the religious rules, and there is no birthright as such. Then, shares are fixed and they are determined at ancestors' death. right? The sons receive double the share of daughters when they inherit together. And for widows, unborn children, and escheat, there are special rules. What is escheat? Escheat is when there is no legal heir, then the government can come in and take over somebody's property. So there are certain special rules for the Muslim community in each of these cases. A will can cover only up to one third of net assets. The rest of the two-third are determined by these religious rules. Then there is something called the Married Women's Property Act of 1874. There are certain special provisions that are made for married women which provide them protection. First is that their earning, savings and income are their separate property. It is not claimable by any other relative like husband or any male heir or something. She can independently take insurance policies. The policies purchased by the husband for wife or children constitute a trust protected from creditors. So let's say a husband has purchased a life insurance policy for the wife, and the husband also dies without settling his creditors, then the creditors will still not have any claim to the insurance which was purchased for the benefit of the wife. Okay. Then the woman can sue and be sued in her own name for her property. Husband is not liable for her pre-marriage debts. So the husband is not supposed to pay off the debts of the woman which were incurred prior to the marriage. All of these are rules that the government thinks are made important for safeguarding the financial independence and security of women. Now, a final concept is the mutation of property. Now, with all kinds of immovable assets, mainly property, there is a process required of mutation because, unlike in financial products where there's an easy process of nomination and transfer, here there's a requirement of updating things in the government's revenue records. So, with different states, there's different methods of doing mutation and updating the government records regarding land, etc. There are certain important points that need to be noted. It is important for tax purposes and establishing possession. So possession is only established when the government records actually reflect the reality that is supposed to be there as per the estate planning. It is not a proof of legal title. The title depends on ownership documents, right? So just because mutation has happened does not entitle somebody to claim ownership of that asset. The procedures are state specific. So depending on what state the property is in, different kind of rules may apply. And finally, this is essential for selling property or obtaining building permission. So any kind of transfer you want to do, any kind of construction activity you want to do, any kind of loan you want to take against it, etc., it is important to have it mutated in the right name. And therefore, mutation is the administrative recognition of the new property holder. So depending on where you are in life, what stage you are in, you might want to start thinking about estate planning, start creating a will. It can be modified any number of times, and you can, as you go through different stages in life, you can include and exclude assets and liabilities from the will or the estate planning that you do. So that brings us to the end of the topic for today. If you're interested in enrolling for the course, you'll find the link in the description below, and see you in the next class.